Hi, good morning everyone. We started this series to discuss some important questions for SEBI exam, the upcoming exam, which is on 17th of January. So in continuation with that, we will discuss questions today related to the Companies Act. Just to give a brief once again to recapitulate the general stream, for general stream in paper 2, there are 6 subjects that are being covered. There is commerce and accountancy. So we are going to cover all these 6 in different series. In this series basically for most important questions. So for the first commerce and accounts and costing, we've already had a session on 26th December. In case you have missed, you will find the link in the description. Today we are going to discuss the Companies Act and the finance, economics and management will be discussed over the next 3 days. So stay tuned, do sign in every day at 11 to see these questions. Okay, starting today with the first question for Companies Act straight away. It will be good if we keep participating because this will help you to know how much you remember and it will be a good revision for you. So starting with the first question, a prospectus includes a red herring prospectus. So this is given as per the definition. This is a part of the definition of prospectus given in the Companies Act, that it also includes a red herring prospectus. So which of the following actually defines a red herring prospectus? Okay, is it a summary prospectus which gives the salient features of the issue? It is a prospectus that can be used to make multiple issues. It is a prospectus that does not specify the price or number of shares being offered, or is it a prospectus that is issued to SEBI for its approval before issuing to the public, or none of the above? Yes, so it's a relatively easy one, but red herring prospectus, shelf prospectus, abridged prospectus, these are very, very important concepts, and having clarity in all these is very, very important. So very good that all of you are correct that it is a prospectus that does not specify the the price or the number. So usually a price band is given. If you will hear the news of any IPO, a price band is given from this range to that range. You can apply. Okay, so that's why it's a red herring prospectus, and the process used is known as the book building process. Okay, so a few more things I am adding here. Okay, the IPO which uses a red herring prospectus, the price is fixed through the book building process. Right? This a summary prospectus is basically an abridged prospectus. The second one is actually a shelf prospectus. This one we actually called a draft prospectus, and this we have already known as a red herring prospectus. So just a glimpse of different types. Prospectus is defined under section 270, which shows that it can be any notice, circular, advertisement or a document which is inviting from the public for subscription or purchase, and it includes the red herring prospectus. Shelf prospectus, as I told you, it can be used for multiple issues. Another important question which keeps coming is, what is the life of a shelf prospectus? That is 1 year. So this is also an important question that you should remember. Okay, it could be like which prospectus has a shelf life of has a life of 1 year, so that is shelf prospectus, or it could ask the other way, what is the life of a shelf prospectus? That is 1 year. So this is a very important information that you should remember. Red herring, as we already discussed. Draft is what you first submit to the SEBI. Letter of offer is the the offer document that is used in case of a rights issue. And abridged prospectus, I told you, it is a shortened form which has to be attached with the application form. Okay, so these are the different types of prospectus. Moving to the next question. This is not directly from the Companies Act, but because it is related to one of the important aspects that we covered the prospectus and the related process of IPO. That's why I have covered this. And IPOs have been in news a lot this year. There have been a lot of successful IPOs this year. So you should be aware of this. Okay, so for the second question, please when you're writing in the comments, do write the question number and then the option, because otherwise it gets confusing if you have answered for the previous one or for the current question. Okay, so in relation to the application in IPO, what is the full form of SCSB? Okay, you might have read allotment, will the money be deducted? Okay, so this was done so as to unnecessarily reduce the timing and the process involved in first taking the money and then returning the money in case you do not get the allotment. Okay, so this is the process, and the money is blocked in a bank, and that bank which provides this facility is known as the self-certified syndicate bank. Okay, so both the full forms are important. Okay, next question. Next question. The underlying shares in case of GDR. Okay, GDR, here in the question there's a full form also written. So this is also, I hope all of you will remember that GDR stands for Global Depository Receipts. There's another term known as ADR. That is also what you can write in the comments box. What does ADR mean and how is it different? Okay, but in case of the underlying shares in case of GDRs, they are allotted in the name of which of the following? Is it the domestic custodian, the domestic depository, the foreign GDR holders, that is the investors, or the foreign depository bank, or none of the above? 3 is Abhinav says B. Okay. The answer here is the foreign depository bank. Okay, so what happens is, if I explain you diagrammatically the explain, this is the company, this is the domestic company, say for example Infosys Limited. Okay, and they want to issue the GDRs, so they will keep the share, the GDRs issued against some equity shares. Okay, so those equity shares are kept in a domestic custodian. Okay, so there is a company, say ICICI Securities is the custodian, and they provide the custodian services also. So the shares will be kept with the custodian in India. However, in its books, Infosys Limited has issued them in the name of the overseas depository. Okay, so there is a depository agreement between the company and the foreign depository in whose name they are issued, and the custodian agreement is between the domestic custody and the overseas depository. And then these overseas depository, they will issue the GDR, they will create the GDR against these shares and issue them to the foreign investors. Okay, so GDR is basically an instrument which is created for the foreign depository outside India. Okay, the underlying shares, as I told you, are allotted in the name of the foreign depository, and they are kept in custody in a domestic custodian bank. Okay, so before this we move. So ADR I had asked. ADR is the same thing as GDR. How the difference is, instead of global we say American Depository Receipts, and these are exclusively when you are issuing in the US markets. Okay, and anywhere else you will call them global. Okay. Next question. As per Companies Act 2013, the balance in Securities Premium Account can be used for which of the following? The following purposes, except which of the following? Okay, so there's a securities premium account that a company can create if they are issuing shares at a premium, right? So this balance they can use for which of the purposes? Can it use it to issue fully paid bonus shares? Can it use it to issue rights shares at a discount? Can it use it to write off preliminary expenses or for buying back of own shares or securities? And or it can be used for all of these purposes. Okay, so so most of you are saying E. Okay, some have said B, some say C. Okay, so good to see Ankit Raj and Vinod Chauhan. The correct answer is actually B. The securities premium cannot be used to issue rights shares at a discount. Okay, so even if you did not remember this, very logically, okay, rights shares when they are issued, if you know what rights shares are, you will still be able to attempt this question. Why? Because in rights shares, what are you doing is you are still collecting money. You are issuing shares to the existing shareholders, right? You are giving them to the existing shareholders at a discount to the market price. Please remember, the discount is to the market price, because discount to the face value is not allowed only by Companies Act, right? So issuing of shares at a discount to face value is prohibited by Companies Act. But when we are issuing rights shares, they are being issued at a discount to the market price, right? So anyways, the company is collecting money. So why will it need to use its own reserves? It does not need to use its own reserves at all. Okay. So if you forget also, if it is rights shares, anyways, they don't need to use any money of the company for issuing rights shares. Okay, so the answer is B and not E. This is a summary of the section 52, which talks about issuing shares at a premium. Basically it means is when you are issuing at a price which is over and above the face value of the security. For example, if we are saying we are issuing at 100 and the face value is 10, then the 90 rupees is basically your premium, which will go under the securities premium account in your balance sheet. Okay, securities premium account, it is shown as under the reserves and surplus of the balance sheet. And what can it be used for? It can be used to issue fully paid bonus shares, to write off any preliminary expenses. Preliminary expenses are expenses the company has incurred before it started operating. Okay, so those expenses it can write off with this premium. It can write off commission or discount paid on the issue of debentures, or premium which is payable on redemption, or for buyback of shares. Okay. Fifth question. Sweat equity. It's a very important concept, again, very recurring concept that SEBI keeps asking about. So sweat equity, these are shares, who are they issued to, and if they are being issued, how are they approved? Okay, so sweat equity shares are issued to dash for consideration other than cash through a dash resolution. Okay, is it issued to the creditors and approved through a special resolution, or is it issued to the directors and employees through approved by a special resolution, or to the contractors approved through an ordinary resolution, or is it issued to the debtors of the company through an ordinary resolution, or none of the above? So for fifth, okay, so yes, all of you are right. It is B. So sweat equity shares, in case you ever get confused, sweat, okay, खून पसीना जो लगा रहे हैं company में, you are issuing it to them, right? So that's why they are known as sweat equity, because it is given in lieu of the services that a director or an employee has provided to the company. They are different from ESOPs. Please remember, they are different from ESOPs because sweat equity are issued at a discount to face value. Okay, and ESOPs can be distributed at a discount to the market value. Okay, so they are not the same thing as ESOPs. ESOPs are different from sweat equity shares. Okay, and because you are issuing them at a discount to face value, which is generally prohibited by Companies Act, it needs to be approved through a special resolution. Okay, it's an exception to issuing shares at a discount to the face value, right? So these are the guidelines related to sweat equity shares given in the Companies Act. One, they can be issued to the directors or the employees of the company. They are issued at a discount and or for a consideration which is other than cash. Okay, so no cash is taken for this. ESOPs, you take cash. Okay, some amount is taken when the people actually apply for that option. Okay, and why are they provided? They are provided for the know-how or knowledge or any available rights they have given for the intellectual property. So as I said, खून पसीना उन्होंने लगाया है company में. So because for that you are being paid in lieu for that in the form of sweat equity. Okay, the Companies Act also specifies the limit of how much sweat equity can be given. So the maximum sweat equity that shares that can be issued are 15% of the existing paid up capital of the company, or 5 crores, whichever is higher, and it can go up to a maximum of 25% of the paid up capital of the company at any time. Okay, in total, and this is in a year this is how much you can give, and this is in totality is the max you can go is to 25%. In case of a startup, the max you can go is to 50%. Okay, it needs to be approved by a special resolution. Okay, and the special resolution needs to specify how many shares you are going to issue, what is the current price, what is the consideration in lieu of which you are paying these. And the other conditions related to this, once these sweat equity shares are given, these have a lock-in period of 3 years. That means the person who's got it, he cannot sell it before 3 years at least. He should be there in the company and should not sell those shares for at least 3 years, right? So these are some guidelines important that you need to be aware of. So this is also very important topic and a very favorite topic of SEBI, asking usually some question on sweat equity. Just to give you a news related update related to sweat equity, in November 2020, if you are thorough with reading newspapers, or even if you are following the Bpedia, which is the general awareness magazine of ixamBee, you would know this news that in November 2020, SEBI had set up an expert committee to review the framework of related to ESOPs and sweat equity, share-based employee benefit. Mostly it is if I tell loosely, it is basically covering the ESOPs and the sweat equity framework. Okay, the policies and related and regulations given relation to sweat equity in the Companies Act. So this SEBI has asked it to be reviewed, and the chairman of that committee is Mr. Sandeep Bhagat. He is a partner at SRN Associates. Okay, so maybe this question in your GA section of paper 1, or even in this paper under finance or Companies Act, can be asked that who is heading or who is chairing the committee made by SEBI in this regard, right? Next question number 6. So Sumit, it's not necessary it is given to first few employees only. As I said, it can be given to employees or directors. Usually it is given for their know-how or any intellectual property that they are sharing, the rights they are giving to. So it does not necessarily have to be the first few employees, but generally, practically, they may end up to being those. Okay. Question 6. As per the Companies Act 2013, a company cannot issue debentures that have which of the following features? Okay, Vinod, 6E. So according to you, Companies Act, they cannot issue any of the above points. Okay, So answer is not E, it is C. The others who have mentioned, Shivangi, Shubham, Masoom, Bhatt, Himanshu, all of you are right. It is C. A debenture can never have a voting right. That is the critical difference between a share and a debenture. A shareholder is known as the owner, okay, because he is giving in his money. He has the voting rights, he has a claim over the profits. Okay, a debenture is basically like a lender. Okay, so he does not have any voting rights in the company. He is like just a lender. He gets interest for the money he has given, and after the maturity, he is he has the right to get his money back. That is the redemption of a debenture. Okay, a confusion, I can agree why it has come from the point D, having perpetual maturity, because as per Companies Act rules in relation to debentures, what it allows is a company may issue wholly or partly convertible debentures. When we say convertible, basically after certain lapse of time, as per the conditions mentioned in the at the time of issue of the debentures, these may be convertible into equity. Okay, so a company is allowed to issue such kind of debentures. However, it has to be approved by through a special resolution. Okay, but a company can never issue debentures which have a voting right. When they are issuing debentures, they have to create a debenture redemption reserve. So there are SEBI rules related to DRR, debenture redemption reserve. You have to be updated about them. It's not directly under Companies Act, but it's an important aspect in which SEBI has given guidelines, so be aware of those. It is mandatory to have a debenture trustee if the number of debenture holders is more than 500 people. So if you are coming out of the public issue of a debenture, you need to have a debenture trustee. Okay. Okay, so the last point which I mentioned, that the D point, having perpetual maturity, this may have created confusion. However, why I have included that point is to drive this point in your head, that the Companies Act is basically saying the maximum tenure of a debenture is 10 years. However, they have said this for only secured debentures. Okay, the word secured here is very important. They have said that secured debenture should have a maximum tenure of 10 years, which can go up to 30 years in case it is issued by a infrastructure company. But the Companies Act is silent about the maturity of an unsecured debenture. Okay, so maybe a perpetual maturity debenture, if it is of unsecured nature, may be issued. Okay, Companies Act is silent about it. They have neither approved, they have neither prohibited. Okay, but definitely for a secured debenture, they have given a 10 years period. Okay, so I hope now you don't have any confusion and you will remember this fact, that this 10 years has been mentioned for secured debentures. Another just a question coming to my mind, even preference shares have a limit, a tenure limit. So please write that in your comments box. I'm just moving ahead. What is the maximum period for which a preference shares can be issued as per Companies Act? Okay, this is a question related to the dividend. A company can declare dividend out of which of the following: the current year surplus, which has been transferred to the profit and loss account balance, from the general reserve, from the Securities Premium Reserve, or from the Revaluation Reserve. So from which of these following, which of the balances can a company use to declare dividend? Yeah, Shubham, that is correct. Preference shares can be issued for up to 20 years, and again 30 years in case it is issued by an infrastructure company. So yes, all of you are correct. Okay, question number 7. A company can use the current year surplus or the general reserve for declaration of dividend. They cannot use balances from the securities premium or from the revaluation reserve. Basically, what the guideline says is you can use your free reserves, but not your reserves which are not realized. So revaluation reserve is a reserve where the profit has not actually been realized. right? And securities premium had limited usages, which we had already discussed in a previous question. The Companies Act declaration of dividend is covered under section 123, where it says you can declare dividend out of the profits of the company for that year, okay, before arrived at after providing for depreciation, or you can use the profits of the company for previous financial years, right, which has remained undistributed. So this amount actually goes in your general reserve which has not been distributed or has not been used for any other purpose. It's usually indicated under the general reserve under in your balance sheet, okay, and this is your surplus profit and loss. So if you see any balance sheet, you will see a surplus profit and loss, you will see a general reserve. So you can use that, or you can use both, or any other money provided by the government in pursuance of any guarantee given. Okay, so these are the sources from which you can declare the dividend. Another question on dividend. As per Companies Act, a company should transfer the dividend to the unpaid dividend account, right? So when are they liable to transfer it? If the dividend remains unclaimed for how much time? So for D, so 7th question, most of you were right for your D question. And in this question, for how many days the dividend is remain unclaimed when you need to transfer it to the unpaid dividend account? Okay, so majority of you are saying D. Okay, D is not correct. The answer is 30 days. Okay, so there are two aspects, two dates. Please don't get confused. Please read the question very carefully when it comes in the exam. It is that first thing is that if once the dividend has been declared, it becomes an obligation for the company to pay that dividend. Okay, it is not compulsory for the company to declare dividend, but if they have declared it, then it is compulsory to pay it, right? So now they have declared, so it is compulsory. However, if they are not able to find any shareholder whom they have to pay, okay, they don't have the account details, or because of any reason it remains unclaimed for 30 days, then the company, that money does not belong to the company cannot use that money. They have declared it, they have to pay it. If they are not able to pay it to the right person, to the right shareholder, they have to transfer that to the unpaid dividend account, okay, in within the next 7 days. Okay, so a question can also be within how many days of remaining unclaimed do they have to transfer it to the unpaid dividend account. In that case, the answer will be 7 days. But for how many days they have to wait, that is 30 days. Okay, after this there is another step. If the amount remains in the unpaid dividend account for a certain period, you then have to transfer it to another account. Okay, you can write in the comments what exactly that is. I'm moving to the next question. As per the Companies Act 2013, the first auditor of a company has to be appointed within what time of the registration of the company and by whom? So there are two parts in this question. First is within how much time the first auditor of the company has to be appointed, and then who appoints that auditor. Okay, so yes, Anshu, that is correct. IEPF after 7 years. Okay, so if it remains in the unpaid account for 7 years, then that money is then transferred to the Investor Education and Protection Fund. This account is not with the company. This is with SEBI. Okay, 9th question. E is correct. You have to appoint the first auditor within 30 days, and this is the responsibility of the board of directors. This is in the case of a non-government company. For a government company, the rule is different. Again, you can write it in the comments. What is the rule for a government company? So Ashvika, the things have become digitized, and dematerial form of holding shares has been mandatory only from 2019, right? The act is much older, and before that people also had physical shares. Okay, so maybe somebody held a physical share and after that they changed their address. Okay, so initially the dividend checks also used to be posted at the registered postal address of the shareholder. Okay, so many times that is also there. Now it has been made mandatory, but there are still people who hold physical shares. Okay, so Ashwika, I hope your query is answered. So going forward, this should not happen. But then there can be another possibility. The account number which the shareholder has given to the company. What if he closes that account and does not, intimate the company and does not give the company the new account number? So in that case also they will not be able to pay to that person. So 60 days CAG is correct in case of a government company. Question number 10. As per Companies Act 2013, an auditor of a company cannot render which of the following services? So there are certain services which are prohibited for an auditor of a company to provide to that particular company in which he is the auditor. So which one of this is not allowed? Shivangi, the latest amendments, there is a note under Companies Act. You will find the amendments there. And those amendments have also been updated in the relevant sections of the other chapters which are covered in the notes. Okay, so the service that cannot be rendered by an auditor of the company is the internal audit. Okay, so the statutory auditor cannot be the internal auditor also of that company. Okay, so these limitations are given under section 144, where they have given a list of services which cannot be done by the auditor of the company for that particular company. One is the accounting and bookkeeping. So the person who is maintaining accounts cannot also audit them, right? So it is conflict of interest. Okay, then he cannot be the internal auditor. He cannot design or implement the financial information system of that company. He should not be providing the actuarial services or investment advisory services or investment banking services or any kind of outsourced financial services to that company, even management services or any other service which may be prescribed or specified by the government in this regard. Okay. Another important aspects that you should be aware of in terms of auditor is the disqualifications related to auditor and the tenure of the auditor. Okay. Question 11. As per the Companies Act 2013, an individual can be a director in a maximum of how many public companies? So 10B, most of you answered, that is correct. So 11 answer is D, 10 and not E. Some of you have mentioned E. The overall limit is 20. That is the overall limit in any kind of company, including the alternate directorship. 10 is when you are in public companies. Okay, in public companies is the maximum you can be a director in 10 companies. And there is another limit given by SEBI LODR regulations for listed companies. So you can be a maximum, this date has already expired, so the first line now you can ignore. Yeah, so the first line now can be ignored because this time has already passed. So listed companies, in listed companies you can a person can be a director in maximum of 7 listed companies. Okay, so 3 limits you have to remember. 20 is overall, 10 is public companies, and 7 is listed companies. Okay, so this is maximum directorships. Another question, if I asked, what is the maximum directors in a company? Okay, so there are two different questions. This is a person related. One person, how many companies he can be a director? There's another question, in one company, how many maximum directors can be there? Okay, that you can write in the comments section. The maximum directors that can be there in a company are 15 as per Companies Act. Exception is there, okay, to that 15, not exception, but you know, a person can work around it, but otherwise the rule is 15 should be the maximum directors in one company. Question 12, which of the following will be considered an independent director of a company? Okay, the managing director of a subsidiary company, the director nominated by the government on the board, a director who has a pecuniary relation with the holding company for 3 years preceding the current financial year, or all of the above will be considered an independent director, or none of the above will be considered an independent director. Okay. So the answer is C. He will be considered an independent director because as per the rules, the person should not have a pecuniary relationship with the holding companies for the current year and the 2 years preceding the current year. Okay, so if he had a relation 3 years prior or any time more than 2 years, then he can be an independent director in a company. So the Companies Act gives a long list. Okay, it is available in the Companies Act. You can go through that. The pecuniary relationship, as I said, it is for the current and then the last 2 years. There's another full list that you should be aware of, who can and who cannot be an independent director. Okay, if you want to know, you can pause and go through this list later. Otherwise, it's also there in the Companies Act. Okay, moving to the next question. How many minimum number of board meetings should be held by a public company in a year? Okay, so question number 13. The minimum number of meetings that a board meetings that should be held in a public company in 1 year is 4. Okay, so these are the rules related to the meetings of the board. They are given in under section 173 of the Companies Act. They first specify that the first board meeting should have been held within 30 days of the incorporation, and the subsequent meetings in case of a public and a private companies, there should be at least 4 held in a year, and the maximum gap between 2 meetings should be 120 days. This was relaxed to 180 days in times of corona, okay, until September 2020 only, but only for that duration this rule was relaxed. Otherwise the rule is 120 days. So if the question comes, you have to stick to this. You don't have to go to the exception. I'm just highlighting this because some may have read in the news and may say it is 180 days. So please don't go by that. And for one person companies or dormant companies or small companies or private startup companies, all the other private companies have to follow this rule. This is private startup companies. You have to have at least 1 meeting in each half of the calendar year, and the minimum gap between 2 meetings should be 90 days. Okay, here it's the maximum gap, here it is the minimum gap between 2 meetings should be 90 days. Also, when you hold a meeting, the notice has to be sent to for the meeting at least 7 days before the meeting. Okay, so that is also one question that can be asked. Moving ahead, question 14. The board of a company which consists of more than how many shareholders at any time during the financial year has to constitute a stakeholders relationship committee? Okay, so this is a subcommittee of the board of directors, a shareholders relationship committee. How it is not mandatory for everybody to have this committee. This is mandatory for the companies which have a certain number of shareholders. So what is that? So it is 1,000. Okay, so if a company has 1,000 stakeholders during a financial year, then they need to have a stakeholder committee. This is given under section 178. Okay, a company with more than 1,000 shareholders, debenture holders, deposit holders, or any kind of security holders at any time during a financial year need to constitute a stakeholder relationship committee. The composition related rules is that the chairperson should be a non-executive director, and any other members as decided by the board. And what is the work of this committee? The work is to consider and resolve the grievances of the security holders of the company. The other two very important committees, sub-board committees, rules related to which are given under Companies Act is your audit committee, which looks at the transparency and accuracy of the financial information. So that ensures this committee ensures that. And the other committee is your nomination and remuneration committee. Okay, they look at the appointment of the board of directors and the important key managerial personnel of the company. Okay, so these two are also covered under the Companies Act, so please do read about these two also. The last question for today from the 27th chapter, which is there in the syllabus for SEBI: who can be appointed as a chairperson of NCLAT? Okay, so it is either the judge of the Supreme Court or the Chief Justice of a High Court. Okay, so he can be a chairperson. So this is given under chapter 27, which relates to the tribunal, which is NCLT, and the appellate tribunal, which is NCLAT. Okay, so here I have asked for NCLAT. The chairperson can be either the judge of Supreme Court or the Chief Justice of a High Court, and they have to be appointed in consultation with the Chief Justice of India. Okay, apart from the chairperson, who are the members? They are the judicial member and the technical members. The judicial members will consist of High Court judges or judicial member of the NCLT who have been judicial member of the NCLT for 5 years. Right, and technical members will be the people who have the specialized knowledge in their experience of at least 25 years in that domain. Right. So these were the most important questions from our end for the upcoming SEBI exam. As I mentioned, we will be holding more sessions to cover the other remaining 3 subjects. We have already covered commerce and accounts, and today we have covered Companies Act. We will be covering finance, economics and management in the coming week for the next few days. So please do log in. And all the related expert faculty will be taking these sessions. Do subscribe and press the bell icon if you have not done it till now, right? And stay tuned for any other updates from ixamBee for any of the government job related preparation. Thank you everyone for joining in today. Have a good day.